I walked you through my 10 largest high-yield holdings in April, then numbers 11 through 20 in May. Today, I'll cover the other 17. That's a lot of stocks and funds, so this will be the lightning round, hence the double espresso. If you're looking for high-yield investment ideas, today's episode wraps up my portfolio that's currently yielding 10.8%. These last 17 are a mix of investments I'm transitioning into or out of, or are just too risky to hold in a large allocation. We'll move in descending order from the largest weighting of the 17 down to the smallest. Number 18, WDI, is currently yielding more than 12% and has a very healthy looking distribution chart. By the way, I plan to cover numbers 21 through 37 of the portfolio today. Starting at number 18 sounds confusing, but it was 22 last month, so it didn't get a mention. Since then, I bought some more WDI, which is why it moved up 4 spots to number 18. All right, the only thing I don't like about the distribution chart for WDI is that it's brief. WDI has only been around since 2021, and their timing for launch was terrible. It's a fixed income fund, so it's made up of hundreds of corporate bonds, CLOs, loans, and other debt instruments, all things that decline in value when interest rates are rising. So it got off to a terrible start. Then when the Fed stopped cutting rates, it leveled out. The discount to NAV looked good, so I bought some. They also recently raised their dividend, so I bought some more. Number 21, Hercules Capital, was ranked 20 in the last video, so we've already covered that one. Number 22 is the Double Line Income Solutions Fund, ticker DSL, and it's currently yielding 10.5%. This is a closed-end fund focused on fixed income. It holds over 400 investments spread across a variety of debt instruments, but the biggest concentrations are in corporate bonds. What makes this fund a little bit different is exposure to emerging market bonds. The distributions took a hit during COVID, and rising interest rates have hurt the performance of the fund. Although, to be fair, if you owned it in 2021, that huge special dividend more than made up for the cut. Looking ahead, if interest rates fall, DSL's bond portfolio will rise in value and the performance will bounce back. It uses leverage of just over 20%, which is relatively modest for this kind of fund. And if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, because now they pay for everything. I mostly focus on stocks and funds paying consistent yields of 8 to 12%. Number 23 is PFN, yielding almost 12%. This one comes from PIMCO, and it's yet another fixed income closed-end fund. For me, it competes with the last one I mentioned, DSL. Both have over 400 investments in a variety of debt instruments and exposure to emerging markets. So which one has the best performance? Over the past 10 years, they both sucked. COVID and rising interest rates beat both of them down, but of the two, PFN has delivered a higher return. Not surprisingly, PFN is priced higher than DSL on a relative basis. PFN is trading at about 5% over NAV, while DSL is close to 1.5% over NAV. PFN has a much longer distribution history than DSL. It goes back almost 20 years. We can see that the 2008 global financial crisis hit it pretty hard, and since then distributions have been quite consistent. There was a small cut after the pandemic of just under 1 cent. Number 24, Blue Owl Capital, is currently yielding about 8.5%, and this one is a business development company, or BDC. That means they lend money to medium-sized businesses, a bit like a bank, but instead of lending out deposits from customers, they borrow money at long-term rates and then lend the money out at higher short-term rates. I've been gradually shifting from owning individual BDCs to simply buying the PBDC fund, which I spoke about in an earlier video, because I think Putnam, the fund manager of that fund, is better at following this market than I am, but I still keep some small allocations to BDC favorites like this one. The distribution history is confusing because the amount dropped, but then they started paying these special dividends. If you add the special dividends to the regular dividends, the recent payouts are at now an all-time high. On top of that, the 8.45% yield doesn't include the special dividends or the recent increase in the regular dividend. If they continue to pay the regular dividend at the 37-cent rate, That would annualize to a 9% yield, and the special dividends would push that yield even higher. But that's not actually the most impressive part. Most high-yield investments don't offer much appreciation. Blue Owl has been appreciating like a tech stock. If you combine price and dividends for the total return, Blue Owl Capital has outpaced the tech-heavy S&P 500 over the past year. Number 25, Gladstone Capital, is currently yielding about 8.5% and is also a BDC. Not much in the way of special dividends, but the distribution trend has been solid since the 2008 global financial crisis. What I like about this one is their conservative approach to lending. The average debt-to-equity ratio for BDCs is 116%. Everyone knows that, right? But here we can see Gladstone at just 86%. Maine also has a low ratio, but it's paying a much lower yield. This chart came from a BDC report from Raymond James. I'll include a link to it in the description. It's free. If you want more detail on Gladstone's conservative approach, Roberts Bursons has written several excellent articles on Seeking Alpha. I'll put a link to the most recent one in the description. Number 26, THQ, is yielding a little over 10.5%, and this one is a closed-end fund focused on healthcare. The distributions have been consistent over its 10-year history and enjoyed a significant increase at the beginning of 2024. My only concern about this fund is that they might have overdone it with the increase. That was a pretty big pop. This was addressed recently in an update from SimplySafe Dividends paid subscription service. They basically said that the huge bump is sustainable under current market conditions, but in a downturn, it's vulnerable to a cut. If you're looking for a more conservative healthcare fund, they suggested BME, which I don't currently hold. They're probably right, but I'm sticking with THQ on the assumption that if the market tanks, they'll cut the distribution by 20 to 30%, and it will still yield more than BME's 6.3%. THQ currently holds over 100 healthcare stocks and is heavily weighted to many of the big names you're probably familiar with, like Eli Lilly, United Health. The fund generates income by selling covered calls on some of the portfolio and capital gains when it sells individual stocks at a profit. There's also 20% leverage to boost the income. Number 27, FSCO, is yielding almost 11%, and it's another fixed income fund. The distribution history looks great until you check the timeline and realize it's less than 2 years old. The fund actually opened 11 years ago, but in late 2022, it converted from private to public. When it went public, suddenly investors could sell any amount instantly, and some did. That hurt the price over the short term, as you can see here, but buyers in the open market soon flooded in, and that discount to NAV has been shrinking rapidly ever since. Over the past year, it has delivered a total return of double the S&P 500, which is frankly ridiculous. Number 28, Arbor Realty Trust, is yielding just over 12%, and it's a mortgage REIT. A standard REIT, also known as an equity REIT, owns real estate. A mortgage REIT lends money for the purpose of buying or improving real estate. Lending is generally riskier because the fund's assets aren't bricks and mortar buildings, like with a regular REIT. With an M-REIT, the assets are the people, meaning management's ability to create a spread between borrowing and lending. ABR's dividend history has been excellent over the past 12 years. Going back further, frankly, it was a mess after the 2008 global financial crisis, but that was because they were involved in risky loans on land and hotels. They then switched to lending on multifamily, and their business has improved dramatically ever since. In 2024, the multifamily lending space has experienced some challenges, so I reduced my allocation to ABR out of caution. I'm now in the process of slowly building back my allocation. If you'd like a copy of my full portfolio, there's a link in the description, and I send out updates about once a month, or more often if it's been busy. It's called Armchair Insider, and it's free. I basically go into my Snowball account, click here, and it produces a spreadsheet with tons of data. To clean it up, I paste the yield and allocation into a new spreadsheet because if there's a relevant video, I want to paste a link to that so they're easy for you to find. I use Snowball to keep track of my current and future income. There's a link in the description for a free trial and a discount. Number 29, SLRC is yielding just under 10%. It's another BDC and it's enjoyed a nice bump in price recently. The dividend history is a little bit confusing. It looks like there were 2 cuts when in fact there was just 1 back in 2013. This dip is when they went from quarterly distributions to monthly and then back to quarterly. The annual distribution amount is $1.64 either way, so it's not really a dip. One thing I like about SLRC is that more than 97% of their loans are first lien positions, which means if the borrower can't repay, they send Fulvio around with a baseball bat. I'm just kidding. SLRC is first in line to collect when they sell off the assets that secured the loan. Number 30, FDUS investment, ticker FDUS, is yielding just over 8.5%. If we look at the distributions going back to 2011, it looks like there was a big pop and then a drop. That's a little bit misleading, and so is that 8.5%, but in a good way. Zooming into the last 3 years, we can see distributions that are a combination of regular dividends and special dividends. The regular dividends haven't fallen. They've been level at 43 cents for the past 3 quarters. The special dividends have fluctuated, and it's important to note they're not included in that yield of 8.5%. So if you held FDUS for the past year, you received a total of $2.76, of which $1.72 came from regular distributions, and the rest were specials. $2.76 divided by the current price of $20.05 gives a 12-month trailing yield of 13.8%, and that is a huge yield. Number 31, MAXI, is a Bitcoin ETF, and it was one of my smallest investments. But with Bitcoin, anything can happen, and it turned out to be the highest return in my portfolio. Who knew? So it grew to a higher allocation all by itself. If you look at the 1-year total return, it makes the S&P 500 look like it's just standing still. This ETF is from Simplify, the people who brought us SVOL. It trades Bitcoin futures and pays out the profits as distributions. I assume Bitcoin could fall 50% tomorrow, so I'm not comfortable putting a large allocation into this fund, even though it would have made a lot of money. Currently, they pay out 15 cents a month and then the rest of the profit at the end of the year, which is why the distribution chart looks crazy. They're considering evening that out a bit instead of paying such a huge lump sum at the end. If you want to learn how this fund works, I made a video about it that includes an interview with the managing director of Simplify, Larry Kim. Number 32, the Guggenheim Strategic Opportunities Fund, ticker GOF, is yielding more than 14.5%, which is pretty high, even for a high-yield guy like me. Then you look at the distribution history, and it's, as they used to say in the old Chevy commercials, like a rock. So, crazy high yield, excellent distribution history. My mind goes straight to, where's the risk? This looks too good to be true. This price to NAV chart is a big part of the answer to this question. It's priced at a nosebleed 23% above NAV. Their strategy has been to sell new shares of the fund at the premium price, which props up the NAV. That works quite well until it doesn't. Meaning, if the price fell below the NAV for a sustained period, they couldn't issue new shares without harming the NAV, and the NAV would erode quickly. The strategy has worked since inception in 2007, so I made a small investment in case they're able to keep it rolling. Oh, and I didn't mention how this fund makes money. That's important. It's mostly a fixed income closed-end fund, and it holds just about every instrument you could possibly imagine, from bank loans to preferred shares and many others. Then it adds leverage and it sells options. It's a mixed bag of everything. Number 33 is from the mighty fund manager BlackRock and is currently yielding just over 8%. It's about 20 years old, and over that period, it has outperformed the S&P 500. Not many high-income investments could make that claim. Here's the distribution chart, rock solid, and a couple of huge spikes for special dividends. BST holds tech stocks, and it makes money 3 ways. Number 1, selling publicly traded tech stocks at a profit. That's pretty simple. Number 2, selling covered calls. And number 3, investing in private companies and cashing out when they sell those companies or go to an IPO. I did a full breakdown video on BST. I like this fund a lot, and the only reason I don't have more is that there are so many good income tech funds now, and I'm a bit more weighted to the ones that produce higher yields. Number 34, Main Street Capital is arguably the highest quality BDC of the 50 or so that are out there. It's run both efficiently and conservatively, and investors are willing to pay a high price for that, so it's only yielding 5.9% at the moment. I've been reducing my position in Main in recent months. It's been great to watch the price shoot up so high, but that yield is now a bit low for me. If you're a conservative investor, this one offers a long history of consistent dividend growth. Next time there's a market correction, I'll be looking to buy back in plenty more of this one. Number 35, we're almost at the end. VIASP is a preferred stock from an energy company called VIA Renewables. It's currently yielding 12.77%. This one was a turnaround play. VIA buys electricity and natural gas wholesale and then sells it retail. A huge storm in 2021 and then the war in 2022 caused massive spikes to natural gas prices, and VIA's earnings were hit so hard they cut their regular dividend in early 2023, and I mean cut it completely. Some of the preferred stockholders panicked and sold, causing the price of the preferred to plummet. Despite all this, the preferred stock continued to pay dividends and the yield became very attractive. Other than a few articles on Seeking Alpha, it's difficult to access much information on this one, so my investment was fairly small. If you like analyzing numbers a lot and you want to learn about preferred stocks, they might be for you. I recommend reading the 67-page guide to investing in preferred shares. It was written by a newsletter I subscribe to called The REIT Forum, and it's by far the best introduction to preferred stocks that I've seen. I'll include a link in the description to that guide. It's free. Number 36, JEPI, JEPI, is probably the most famous ETF in the portfolio, so I won't spend too much time on it. It's a covered call fund based on the S&P 500, and it's yielding just over 7%. The distributions vary each month based on the volatility of the S&P 500, but I'll assume that the yield's going to remain in that 7 to 8% range. JP Morgan also threw some value stocks into the mix, so this ETF is designed to hold up well during corrections. I'm optimizing for a yield above 8%, so for me, SPYI is a better fit. Last on the list is a mortgage REIT called Ready Capital, ticker RC, and it's yielding a hefty 14% plus. This one is a small turnaround bet. Speculation. This stock has been beaten down because of its acquisition of a lender named Broadmark, and it's frankly been a mess. Ready Capital has also reduced leverage, which reduces risk, which is good, but it also has lowered the earnings. This has been one of my worst performing investments of the past year, along with TLTW, which I sold a while back, thankfully. It was far too risky to make a video about, but now that I share my portfolio, you can see the broader picture, the good and the bad. These last 17 investments are small positions, and I could definitely ditch some of them. It's not necessary to hold 37 positions to achieve diversification. It's partly because I'm not that great at monitoring watch lists. If something is on my radar and I have some money invested, even a small amount, I pay far closer attention than if it's just sitting on a watch list. I don't think another income investor should hold the exact same 37 investments as I do, but perhaps a couple of the ones I mentioned today might be of interest to you. If you want to learn more about any of these stocks or funds, there are plenty of detailed articles on Seeking Alpha about, all of them, even VIASP. I'll put a link in the description for a free trial and a discount. And if you missed the other 2 videos in this series covering the rest of the portfolio, you can click here to watch them now. That wraps it up for this third and final part of the portfolio walkthrough. More Armchair Income coming soon. Whew.